come and take a look at a chart here that I'm showing inside my terminal, you know this better than anyone else. The share price, which is having a massive run up relative to the street, which actually hasn't caught up with the shares. Dan Ives of Wedbush also noted that $350 on the stock. So did you. Why is $350 your fair value?
Well, I think, Taylor, fair value is somewhere between $350 and $400. I wanted to have a target that I felt comfortable at putting out there as our prediction. So that's the 350 piece. It also is representative of a consumer staples company. Think of Coca-Cola or Procter & Gamble, those type of multiples, a 25 type of multiple. The 400 suggests a multiple similar to Facebook. Typically, Apple hasn't gotten that multiple because it's a hardware company, and investors for the last decade have been concerned about hardware companies and their sustainability. And so when we think about what the proper multiple is, I think that this view that a hardware company is in fact a great business defined by what is impressive cash flow. If you look at Apple, they generate as much cash as FANG combined. And so if we use that as the goal stick here, the cash flow ultimately should drive the multiple. I think it's safe. I think it's a fair assessment to give Apple a fair value similar to what Facebook would be, which you call it 33 times. That yields a $400 target. So to answer your question in the most simple way, 350 is based on consumer staples. 400 is based on a multiple similar to Facebook.
I wonder, though, as they become less and less dependent on iPhone sales as a percent of overall revenue, do you start to look at this company less as a hardware and more as a software, the services, the wearables business? What's your take on that?
Yes, the combination of hardware, it's not just hardware, it's the hardware, software, and services. Hardware is still going to be 75% of Apple's business next year, so this is clearly an important segment. But I think if you look at just how the hardware is performing, it's performing more like a services business. Essentially, we're starting to see some repeatability. About every 3 years, people upgrade their phones. Now we're starting to introduce the wearables piece. Obviously, the wearables segment is included in the hardware piece, but that's starting to take on characteristics similar to the iPhone around upgradability. Think about what's happened with AirPods. So the answer to your question is that you need to look at this holistically and how the products operate and how they impact consumer buying trends. And I think when we look at it through that lens, that this, in fact, is a hardware, services, and software company that performs like a services company. My view, just quickly, of this justification for a higher multiple took a large step back last year with the dip in the iPhone business. Essentially, it's going to be down, call it 9% for 2019. But importantly, this should rebound and kind of stabilize in this low, mid-single-digit growth, and I think that will be reassuring for investors.
Gene, you mentioned the cash flow that this company generates. I want to fold that into some other income statement, balance sheet analysis, which if you come and take a look at a chart inside my terminal, is the cash outstanding, net cash, which is the cash minus the debt, as you know, $100 billion. What is the best use of cash for this company?
Best use is to continue to give it back to investors because I think that the stock is undervalued. And the company has so much resources to make some big acquisition probably is not the best use. And so they've talked about this, call it their net cash position, as you mentioned, is right around $100 billion. And their goal is to be net cash neutral, which means they need to give back. This is on top of the capital return policy that they've announced, is to give back an additional $100 billion. Now, that's a challenge because when you're generating $50 billion a year, that gets hard to knock that down. And they haven't given a timetable of when they're actually going to hit that target of net cash neutral. My sense is we're probably 2 or 3 years away. So the simple answer to your question is the best use for Apple Cash, even though it's not a glamorous use, is to be net cash neutral because I think that shares, it will reward investors by doing that. If they use the majority of their cash, kind of that stockpile that we're talking about, to buy back stock, that in itself should generate about 7% upside to current Apple share price.
Gene, I want to flip to another stock, and that's Tesla. I've talked to 2 bulls and 2 bears in the last few weeks, and they all have come to the same conclusion that Tesla is all dependent on China in 2020. Is Tesla really set up in China appropriately, in your opinion, for 2020?
I would disagree with that, by the way. I think China's an important part. It's 11% of sales today. I think having China Gigafactory there is going to materially lower the cost of buying a Tesla for Chinese citizens, probably by somewhere between 15 and 25% because of the way the tariffs are structured and the transportation costs. So this is important that they're going to be manufacturing Teslas they just started in Shanghai. But that's not the whole story. I think that the whole story around Tesla, just to step back, we're believers in this. We don't have a specific price target. We think it's worth much more than the $77 current billion-dollar market cap. But as we think about how this story progresses, there is an undeniable truth around electrification and autonomy that Tesla plays into. To reach that undeniable truth, or we'll call it escape velocity, when you know this story is just going to work. We're not there yet. The stock would suggest that we're moving in that direction, but we're not there yet. To reach that, I think they're still going to have some bumps in the road over the next year. I think China is going to be a positive swing factor, but ultimately I think that this company has a much bigger ambition beyond China and essentially capitalizing on the 90 million vehicles sold every year and turning those into electric vehicles.
One of your other predictions for 2020 is the rise of the direct listing. If I don't have to raise new money, do you assume that we direct list instead of IPO?
Yes, we're expecting, that's the simple answer is yes. If you don't need to raise money, and the late stage markets are flush with capital now, I think that there's an opportunity for, let's call it 3 direct listings in 2020. Essentially there was 1 or 2 in 2019. So yes, I think that this theme of direct listings is it's for real. I've seen through my years of being an analyst, other talk of other methods for companies to come public, and I believe that this will, in fact, live up to some of its hype. One important aspect, though, right now, the way direct listings are structured is the companies cannot raise money themselves. They can sell secondary shares, but can't sell primary shares. That means they can't bring money into the company to help its investment. Through the process of the direct listing. That likely will change in the next couple of years. Some of those rules will be relaxed, and I think that point, once those rules are changed, I think you're going to see a material shift to direct listings that's probably 2 or 3 years away.